A stock market crash is a sudden and dramatic decline in stock prices across major indexes like the S&P 500 or the Dow Jones. For example, the infamous crash of October 1929, which triggered the Great Depression, saw the Dow Jones Industrial Average drop by nearly 25% in just 2 days. Similarly, during the 2008 financial crisis, the S&P 500 lost more than 50% of its value over a few months. These crashes often result in significant financial losses for investors as market confidence collapses. A crash can occur due to factors like overvalued stocks, economic recessions, geopolitical instability, or widespread panic selling. For instance, in 2020, the COVID-19 pandemic led to one of the fastest stock market declines in history, as fear of economic shutdowns caused widespread panic. Investors typically lose money in such scenarios because they either sell in fear or lack proper diversification or risk management strategies. However, while most suffer losses, certain groups manage to profit during these turbulent times. Short sellers are one of the most obvious winners during the stock market crash. They make money by betting that stock prices will fall. This is done by borrowing shares, selling them at a high price, and then buying them back at a lower price to return to the lender. The difference between the sell price and the buyback price becomes their profit. A notable example is hedge fund manager John Paulson, who famously shorted subprime mortgage-backed securities during the 2008 financial crisis, earning billions as the market crashed. However, short selling carries significant risks, as any unexpected rebound in the market can lead to unlimited losses. For example, during the 2021 GameStop short squeeze, short sellers collectively lost billions as retail investors drove the stock price up instead of down. Contrarian investors also gained during the crash by going against the crowd. Instead of selling, they purchased stocks at steep discounts, often focusing on companies with strong fundamentals. For example, Warren Buffett is well known for capitalizing on market downturns. During the 2008 financial crisis, he invested $5 billion in Goldman Sachs and secured lucrative terms that earned his company, Berkshire Hathaway, a substantial profit when the markets recovered. Contrarian investors understand that crashes present opportunities to acquire high-quality assets at undervalued prices, and their long-term perspective allows them to benefit once the market eventually recovers. Hedged investors use strategies like options trading to protect themselves during downturns. For example, during the 2020 COVID-19 crash, many institutional investors used put options on the S&P 500 to offset losses in their portfolios. A put option gives the holder the right to sell a stock at a predetermined price, effectively allowing them to profit from falling stock prices. Additionally, many hedged investors diversify their portfolios with alternative assets like gold or bonds, which often perform well or remain stable during market declines, providing a cushion against losses. For example, during the 2008 crash, gold prices soared, rising from around $700 per ounce to over $1,000 within a year. Market makers and high-frequency traders thrive on the increased volatility of a stock market crash. Market makers earn profits by facilitating trades and capturing the bid-ask spread, while high-frequency trading algorithms execute numerous trades in milliseconds, taking advantage of price fluctuations during chaotic market conditions. For example, during the 2010 flash crash, when the Dow Jones briefly plummeted nearly 1,000 points before recovering, high-frequency traders played a significant role in both exacerbating and stabilizing the market. Investors with cash reserves are uniquely positioned to benefit during the crash. Liquidity allows them to buy assets at bargain prices when others are forced to sell. For example, during the 2020 market downturn, savvy investors like Cathie Wood of ARK Invest purchased tech stocks like Tesla at significant discounts, reaping massive rewards as the market rebounded in the months that followed. This group often waits patiently for the right moment to re-enter the market, seizing opportunities as others panic. To navigate a stock market crash effectively, some proven strategies can help. Identifying undervalued stocks is one of the best approaches. Crashes often cause even strong companies to trade below their intrinsic value, presenting excellent buying opportunities. For example, During the dot-com bubble burst in 2000, companies like Amazon saw their stock prices drop drastically despite strong fundamentals. Long-term investors who purchased Amazon shares during this time were rewarded handsomely in the years that followed. Dollar cost averaging, which involves regularly investing fixed amounts regardless of market conditions, can reduce the impact of volatility and lower the average cost of investments. Diversification across asset classes, stocks, bonds, commodities, and real estate, is another key method to protect against losses. For example, during the 2008 crash, portfolios with a mix of bonds and equities performed better than those solely invested in stocks. Equally important is staying emotionally detached and avoiding rash decisions, such as panic selling, which often locks in losses unnecessarily. Everyday investors can take valuable lessons from those who profit during the crash. Risk management is essential. This includes setting stop-loss orders, maintaining an emergency cash reserve, and ensuring a well-balanced portfolio. For example, investors who held diversified portfolios that included defensive sectors like healthcare and utilities during past crashes often fared better than those heavily concentrated in speculative growth stocks. Preparing for uncertainty by understanding that market crashes are a natural part of the economic cycle can help investors remain calm and focused on long-term goals. Building a resilient portfolio that combines growth-oriented investments with defensive assets enables individuals to weather market downturns while remaining positioned for recovery. In conclusion, while stock market crashes can be devastating for many, they also present opportunities for specific groups and well-prepared investors. Short sellers, contrarian investors, hedge traders, market makers, and those with cash reserves often come out ahead. For example, during the 1987 Black Monday crash, savvy investors like Paul Tudor Jones used strategies such as portfolio insurance to profit while others suffered losses. For the average investor, focusing on risk management, diversification, and maintaining a long-term outlook can turn a potential crisis into an opportunity for growth and recovery. Thanks for watching.